Canaccord Genuity. Carey, thanks a lot for joining us. One thing that an investor can see very quickly when looking at these numbers is, like a lot of low-cost gold producers, this company in its most recent quarter basically sold gold at double the price that it paid to produce that gold. In other words, the realized gold price was double what the all-in sustaining cost was. Now, that's something that's fairly common, as I said, among the lower-cost producers. What stands out in these numbers specifically to Kinross?
Yeah, thanks, Paul. Thanks for having me on this morning. In terms of Kinross, I think the quarter was more or less in line with what we were expecting. I know the stock is down a little bit today, but I think that, Kinross has been a high flyer, no doubt about it. It's been the best performing senior gold stock this year. It was the best performing senior gold stock last year. So I think the market maybe have anticipated, better than inline results. But I think the quarter really shows, this is a company. It's 2024, I think, was a transformational year. They generated $1.3 billion of free cash flow last year, which is more than Barrick. And as you probably know, Barrick is twice the size of Kinross. This is a company that's paid down $1.1 billion of debt. Again, it was the best performer. So I think the quarter more or less was in line. The company put out their 2025 guidance, which I think came in exactly as advertised. So I think the stock reaction today is a bit overdone, and we continue to like this name. What
the market has wanted to see from these companies for a while is capital discipline. You mentioned the paying down debt. That's one thing that would please investors looking for capital discipline. And what the market also wants to see is profitable growth, not growth simply for the sake of increasing the number of ounces produced. Is the company delivering in that way?
Yeah, no, I think that's fair. I think most of the big gold companies today got in a lot of trouble 10, 15 years ago in the last cycle, the last time gold hit $1,900 an ounce. So I think since then, there's been a lot of lessons learned. Capital discipline is certainly at the forefront. So in those days, companies were building multi-billion-dollar projects. M&A were paying, big premiums. Today, it's more about sustaining production in a measured manner than growth for the sake of growth. So I do think Kinross sort of personifies that.
One of the company's growth projects is the Great Bear project, which was acquired in early 2022. How's that project looking?
Yeah, so they bought that project in 2022. At the time, there was no resource, there was no economic study, and they paid $1.4 billion US. So there was certainly a lot of investor questions on, what were you buying? Since then, they've been drilling it at a very rapid rate. They've now defined 6.6 million ounces of resource. We expect that to grow over time. The deposit's still open at depth. And last year, they put out their first economic study. So you're looking at a mine potentially, or the mine plan, 500,000 ounces a year, all-in sustaining costs of $800. So this is really a tier one asset in the making. And really where it goes from here is they really got to get underground. They're drilling 1 kilometer holes from surface, which is very expensive and time consuming. So the plan there is to get underground later this year, start drilling it from underground. And again, we expect this project to grow. So the current plan is to have this, probably construction in 2027, in production in 2029. And again, it should contribute 500,000 ounces a year, which is a meaningful number considering, Kinross produces 2 million ounces today.
So you're constructive on the stock. The stock is about 5% cheaper now than it was at the close yesterday. You've got a target price of $19.50 Canadian. What kind of metrics and valuation numbers do you use to get to a $19.50 price target?
Yeah, so we look at NAV and we look at, we use EV to EBITDA. And again, underlying all that really is free cash flow. So again, this company produced $1.3 billion of free cash flow last year. If you look at, if we plug in the current spot price of $2,900 in our model, that free cash flow should increase this year by another 40%. So, this is a company that has momentum. We think it's in a Goldilocks position. It's not, and pardon the pun, but it's not too big where it can't grow like some of the super majors. And it's still big enough that it's diversified, still offers investors, good liquidity, and it's got a diversified portfolio. So, in our view, we think, again, Great Bear gets bigger from here. We think there's NAV accretion to come. We think as the gold price continues to go, this is a company that should generate increasing cash flow, EBITDA, free cash flow.
Carey, thank you so much for this conversation. Carey MacRury is an analyst at Canaccord Genuity.